Welcome to our 3-part series on investment basics. You need to be willing to stay the course. Once you've built an asset allocation model, you need to be able to put your head down and not panic when the inevitable correction or bear market occurs. As we discussed, market-based investment accounts will lose money from time to time. It's how you react in these down markets that makes all of the difference in your portfolio's success. Trust that the allocation model you've built is appropriate, even when the value drops. We know that there will be highs and lows in the market, and as a result, our investment balance will go up and down. What we don't know is when those peaks and valleys will occur. In fact, they're very difficult, if not impossible, to predict, even for the brightest money managers. So building an asset allocation model that puts the downside risk at a level we can live with, and staying with it even when the market turns against you, makes sense, right? After all, we built an allocation model that's appropriate with the belief that the growth over time will be there despite these fluctuations in value. That all sounds easy, but then human nature kicks in. We've all heard the phrase buy low, sell high, but that's much harder than it sounds. In fact, it is totally counterintuitive. Imagine if you were betting on a horse in the Kentucky Derby, and the advice was to bet on the horse that just lost the last several races. It doesn't make sense, right? But that's the advice for investing. Buy low. In fact, this idea is so counterintuitive that most people end up doing just the opposite. They get frustrated when the value of their investment drops and they sell. Then, after the market has gone up, they gain confidence and invest again. After the market has risen and just in time for another correction. Here is a study by Dalbar that illustrates just that. For the 20 years ending December 31st, 2015, the S&P 500 index averaged 9.85% a year, a pretty attractive historical return. Yet the average investor in these kinds of investments earned a market return of only 5.19%. How does this happen? Studies show that when the stock market goes up, investors put more money in it, and when it goes down, they pull money out. They did exactly what we've been talking about. They sold when the market went down and bought after it went back up. It's human nature to overreact, but with the knowledge you've gained, you can overcome this. Build an allocation model, adjust it as you age or your personal situation changes, but above all, don't overreact to swings in value. View these investment basics as a first step. Take some time to think about how much risk is appropriate for your age and life situation. Think about how much market volatility you can really handle without making the decision to sell out of a portfolio when the inevitable market correction occurs. Once you've built a portfolio, be confident that it fits you at this point in your life, even in the face of swings in value. Take advantage of the additional resources available on the site to learn more. Talk to your advisor about asset allocation.